So I wanted to do this video to kind of bring some light to all of you who are feeling a little fear, I think would be the best word. For those of you that are watching the news,
I thought the oil prices would go up more, and I thought the stock market would go down more.
you're watching your 401ks, you're watching your stocks and your investments, and you're seeing a lot of volatility. You're watching them go up, down on a daily basis. Things are not making sense. You're hearing about the war in Iran. You're hearing about all sorts of political and geopolitical risks and things, and you don't understand it all, but you got this weird feeling in your gut. Do not ignore that feeling. We are in very interesting times right now, and we could be on the brink of a major fallout in the economy. Now, I'm not saying that's gonna happen. This isn't a doomsday video. I wanna just give you some precautionary ways to protect your wealth, to protect your retirement in a very simple way, but how not to make decisions when it's too late. Let's dive in. I got to take you back to the early 2000s. Back then it was called the dot-com bust. And some of you remember that, some of you are too young to remember what happened during the dot-com bubble burst, but it was a recession. It was a long, prolonged recession, 3 years. I was a retail shop owner. I owned skateboard, snowboard shops. Things were going great before this. And then when the bottom fell out, my business also fell out to the tune of about 30%. Business was down. It seemed like overnight, by 30%. I could barely make my bills. Everything started getting tight. Leverage started piling up, and I didn't know what to do. Well, I didn't do what most of you would, but I went out and I got a job. I needed to. I didn't have any other choice. That job landed me as a financial advisor. In 2002, I became a financial advisor. Now, what happened then was a 16-year run, okay? I was an advisor until 2018 when I sold my practice and let my licenses go to pursue a TV show on HGTV. What today's video is about that gut feeling, that stomach pain that I had back in 2000 when I was going through the dot-com crash as a business owner, because we're right on the brink of something else. Now, since then, we've seen the Great Recession. Since then, we've gone through COVID. Since then, we've gone through a lot of things, but something just doesn't feel right here and now. But you see, back then I didn't know what to do. I was forced to go get a job. I was forced to change directions, change course. I don't want you to have to do that. So in today's video, I'm gonna give you some basic understandings of what we're gonna call the stock market ride. You've all ridden this ride, but unfortunately right now we are in the longest bull run in history. It seems like the stock market just can never do any wrong. It seems like everything you put your money in, well, over a certain extent of time, you're gonna make something. But what happens when the ride changes? You see, it's like a roller coaster. You know, I've been on lots of roller coasters and it's really fun. You know, you're going up that chick. You're kind of just looking straight up at the sky. It looks great, right? You're getting excited, you look around, you're getting higher and higher. It's kind of like your 401k. It's kind of like your investments right now. They just seem to just keep going higher and higher. Yeah, there's every once in a while a little bit of a pullback, and that would be that little drop. But you always know on a roller coaster ride, there's the big one. And when you take the big one, you know how it goes, right? The people up front, you don't see them if you're in the back. The worst place on a roller coaster ride is in the back seat because you're the one that gets that whiplash. Well, this is very much the same for people in the stock market. The people that go over first kind of get a glimpse of it, but the people at the end that wait a little too long, that you kind of kick the can, that just don't take action, they're the ones that feel it the worst. They go down, and as you can see, we're just over here. Crap, stay calm, it's just a correction, just a paper loss. Yeah, all I wanna do is I wanna show you how to avoid that feeling. All right, so folks, I know this is somewhat high level, but it's simple. You just gotta buy low, sell high, and don't lose money. And also another thing you gotta do, click that subscribe button right there. There's also a little bell that comes up, and that bell will notify you every time that I put out new content like that. My Bruce Lee's getting much better. I'm still studying, but so are you, and you're studying how inverse relationship to bonds reacts with, anyway, doesn't matter. Let's get back into the video. And what we're gonna talk about is something called the drawdown risk. Most people don't understand this, but I will tell you, if you've gone through a recession, you do understand this. You remember in your portfolio during the Great Recession, if you're old enough to remember this, you remember your portfolio fell 10%, then it fell 20, then 30, then maybe 40, then you might have even gone down 50%. I hope you didn't, but when you did, That was a terrible feeling. At first, a little bit of fear, a little bit of anxiety, then complete just chaos, and then I can't lose anymore. You see, I was an advisor through 2008, and I saw this for a lot of people. But here's what really was happening. You see, when you're down 20%, that's the magic number. When your investments drop 20%, there's a psychological change. It's been proven. The anxiety that comes along with anything more than 20% is significant. And here's what it's tied to. It's tied to what's called the drawdown effect. When you lose 20%, it takes 25% just to make back your 20. But when you lose 30%, you'd have to make 43% back just to get your 30% you lost. This is pretty simple to understand, but that's a 13% difference. When you lose 40%, which many did in 2008, you'd have to make 67%. That's 27% more just to get back your original 40%. And if you lose 50%, you got to make 100%. Why is this so significant? Well, during 2008, I knew a lot of people, clients for that matter, that lost 20 or 30%. And then they'd watch the news. And then all of a sudden, after some time, about a year, the news kept saying, oh, we're back, we're at all-time highs again, or we're back to where we were before the recession started. I remember that day. I remember some news channel said, the stock market is now back to where it's higher than it was before the Great Recession, which wouldn't that just mean that if you had lost 20, 30, 40%, and you heard that on the news, you'd have all your money back. These people went and they checked their statement. They looked at their statement. They looked at where it was prior to the Great Recession, and they looked at where it is now, and they were still down. Even though the stock market had regained all of its losses, their portfolio was still down. Does that make any sense? Well, it should. Because as you lose money, you have less money invested. Even if all things remain the same, you stay invested like Warren Buffett says, oh, keep your money in for the long haul. When you're down 30%, your balance is 30% lower, which means in order to climb back and make the 30% you lost, it's got to work way harder. 50%, it's got to work twice as hard. This is the drawdown effect. And you know what makes this even worse? Let's say you're retired and you're living on your investments. And then all of a sudden you start taking losses like this. It's game over, folks. The drawdown effects hit someone in an income state or what we call a distribution state of their investments, hits them tremendously hard. Most never recover. They have to go get a job, they have to find another income, or they have to cut their living expenses and change their entire lifestyle. I've seen this happen numerous times, and I don't want this to happen to you. So what is the answer? Well, you see, it's not, just like this shows, it's not what you do when you're here. It's what you do when you're here. This is the emotional part. This is where you make terrible, terrible decisions. So what you do here is important, but it's not as important as what you do here. Now, I'm gonna come over here and I'm gonna show you something. And many of you have heard of bonds. There's equities, there's stocks, and there's bonds, okay? Stocks, you're investing in a company. You're taking equity in a company, if you will. Your risk is, well, potentially 100%. If that stock goes to zero, you could lose it all. Then there's bonds. Bonds are like IOUs. Okay, there's all sorts of different types of bonds, but I just want you to know a bond is like a debt. You're loaning somebody money, an entity, the government, whatever you want. You're lending them money. It's like an IOU. They're then paying you interest for that loan, for that IOU you gave them. And then there's some fluctuation in the price as well. You can make money two different ways on bonds. The interest that you're earning or the yield, and then you can also make price appreciation, or prices could also go down. So how does that work? I used to teach this all the time, but it's based on, to keep it really simple, an inverse relationship to interest rates. So I want you to all just go back a few years ago. Do you remember when we had all that inflation after COVID? They printed all that money, it was inflationary, and all of a sudden we saw inflation touch 9%. And what the Fed does to combat rising inflation and runaway inflation is they raise interest rates, and they did. Interest rates went up, and the inverse happens. So you can just look here, this is an X. If interest rates go up, typically the price of the bonds goes down. So if you owned bonds when interest rates were low, and then the Fed raised interest rates, you lost money on the price of the bonds. And this is all relative to the yield you earn, but I don't want to get complicated. Right now, we're in a different dynamic. Right now, interest rates are moving downward. We see this, we hear about this. You hear the Fed talk about interest rates and what the future direction of them is going to be. And right now, because the economy is fragile, we've got geopolitical risks all over, you got wars happening, the chances of interest rates going up are very slim. The chances of interest rates continuing down are absolutely good. That's what way we're going to go. So just remember, if interest rates go up, the price of a bond goes down. When do you want to buy an investment? When the price is going down. So what I've been doing, and I'm not giving financial advice, but what I did, when interest rates were going up, I was buying bonds. I've been buying bonds the whole time. Again, not telling you should do the same thing as me, but I understood that if interest rates go up, the price goes down, and Warren Buffett always says, buy low. And then Warren Buffett also says, sell high and don't lose money. So simple, right? Buy low. Great. How do I know when things are going to go low? I just told you. Interest rates went up, price went down. And interest rates are still moving down, so the price is still relatively low on bonds, especially long-dated treasury bonds. And primarily what I buy are just government bonds called treasury bonds. So now, as interest rates go down, and as we're on the brink of something weird happening, right? Something feeling odd, something isn't right. So are we gonna go into an economic slowdown? Are we gonna land in a recession? Well, if you follow economists and you follow white papers, most of them are saying, yeah, it's imminent. But when? Yeah, who knows? So we don't need to play the who knows game or the when game. We just have to follow that strategy of buying low and then, with the effort, selling high. And here's how it works. As interest rates push down, the price of those same bonds, primarily long-dated treasury bonds, will go up. Now the yield will fall, but who cares? Because we're not playing that, we're playing the price game. So here we go. Here's your x-axis. Interest rates went up, price went down. Here we are, down here. Price is going up as interest rates are going down. So what will I do? As the Fed drops interest rates, as we get closer and closer to an economic slowdown, as the Fed or somebody says, hey, we're in a recession, they will pull interest rates faster because it will stimulate the economy. The cheaper the money is, the more people that will use money, and that gets an economy back going. This is one of the main levers the Fed uses. So when they do that, price should move. So what I did, now again, this is all hypothetical. I just tried mimicking this, but I went back and I just looked at a very common ETF, an exchange traded fund that buys 25-year plus treasury bonds. It's just an ETF. I mapped it back to 2008, 2011, 14, 17, 20, and 23, and I just stopped there. But all I want to do here is I want to just show you a couple things. 2008, when the recession hit, and I remember this vividly, one of the big actions the Fed did is they pulled interest rates. They pulled them very quickly. They dropped them down to pretty close to zero. And what happened? Well, when they did that, the price of the bonds spiked. See this increase? Now, this is not to scale. This is not exact. You can do your own homework, talk to your advisor, talk to the advisors over at PMC Wealth Advisory. We got you covered there if you want to kind of see this. But you can see the price of the bonds spiked. So before the Great Recession, if you had bought bonds, this particular ETF, you would have bought down here. Okay, just look right around here. You would have bought somewhere around this point. And then in 2008, when they pulled interest rates and the price went up, you could have sold here. So I don't know, not doing it exactly, but let's say you bought them at 80 and you sold them at 110. Would that be a good day in the office? Sure would have been. But hold on, let's keep going. Let's come over here. Another period of time, 2020. You remember what happened in 2020? That was COVID. Do you remember when the whole world shut down? We'll just talk US. When the US shut down, what was one of the first things you saw the Fed do? They pulled interest rates to stimulate the economy, to kind of help everybody to lower costs. They dropped interest rates and literally to almost zero. Some countries went negative. But anyway, we'll just say pretty close to zero. Well, what happened to the price of the bonds during that period of time? And you can see the same thing happened over here in 2014, but I'm really just picking some. Right around here is before COVID. It was a pretty level period of time. Let's just call price of the bonds in the 115 range, 120 range. So in 2020, they dropped interest rates, which drove the price. Remember, price goes up as interest rates go down. And then what happened? Well, because of inflation, the Fed kept increasing interest rates. We got into a pretty high interest rate period. People were really complaining. It slowed the whole real estate market down, created what I would call probably one of the worst real estate markets in the past decade, if even that. It's been awful for real estate investors because interest rates went really high, people froze, they weren't selling houses, yada, yada, yada. Well, this is what happened to the price of the bonds. They fell out of the air. You could buy this particular ETF somewhere in the $80 range right now. It was at over 160 when they pulled interest rates. So the next question I would beg all of you to ask is, where do you think the Fed's going with interest rates right now? Some of you might not even know. But if you think the Fed's going to continue to drop interest rates, if you think things are going to get worse, then you can probably make the assumption that this would be a great way to buy low and eventually sell high and not lose money. Now, I'm not giving advice here. This is just what I'm doing. You don't have to listen to me. But why don't you talk to your advisor? Why don't you talk to some of the advisors over at PMC Wealth? They fully understand this. They learn this when they get their exam and they get their investment licenses. Their security license teaches all of this. Why don't you know about this? Why are you still pushing all your chips into risk assets that are priced really high when you probably can feel it in your gut that something's not right? And when things fall, guess what? Warren Buffett says this as well. When the tide goes out, you're gonna see who's swimming naked. And I don't want you to be swimming naked. So folks, I hope you enjoyed this. This video wasn't for everybody, but for some of you that are just having that weird feeling right now, things aren't just happening the way that they should, and things just feel a little tight, well, this is the time to take action. And I got another video I'd love you to watch right here. The shift is happening. This video covers exactly what we went over, but in depth. Check it out, let me know what you think, and thanks for joining me on this video.